People always ask me how to avoid stock market crashes, as if I've got some secret liver hidden in Omaha that lets me shut the whole thing off whenever I feel uncomfortable. I hate to disappoint you right out of the gate. I can't stop crashes. Nobody can. If someone tells you they can predict crashes, they're either lying, delusional, or running a hedge fund charging you 2% of your money and 20% of your sanity. But here's the good news. You don't have to predict crashes to survive them. And surviving crashes, that's where most fortunes are quietly made. Now let me begin with something slightly impolite but deeply accurate. Most people don't get destroyed by market crashes. They get destroyed by how they behave during market crashes. Markets fall, that's normal. Human beings panic, that's expensive. You see, crashes have been happening for centuries. We had them before computers. We had them before CNBC. We had them before people invented financial influencers who think reading one investing book qualifies them to explain the economy to strangers on Instagram. Crashes are not unusual events. They are permanent features of capitalism. And if you participate in capitalism, you're going to experience them, whether you like it or not. Now, the funny thing is, every crash feels unique when you're living through it. Every crash comes with its own dramatic storyline. People will tell you, this time it's different. That is probably the most expensive sentence in financial history, because every generation believes it, and every generation eventually pays tuition to reality. Let me tell you the first rule for preventing financial crashes from destroying you. It's not sexy, it's not complicated, it's not even particularly clever. The first rule is, never put yourself in a position where one bad event wipes you out. That's it. You would be amazed how many people violate that rule while believing they are being sophisticated investors. You know what wipes people out more reliably than anything else? Leverage. Leverage is like giving whiskey and car keys to teenage boys. Occasionally it works out fine, but the statistical expectation is not encouraging. Leverage makes good outcomes better, but it makes bad outcomes fatal, and markets have an extraordinary habit of delivering bad outcomes precisely when leveraged investors are least prepared for them. I've watched very intelligent people lose everything because they believed they were smarter than volatility. They weren't. Volatility is undefeated. Now, Buffett and we have always had a fairly simple attitude toward leverage. We avoid it unless survival is absolutely guaranteed. And guess what? Survival is almost never guaranteed. So that simplifies decision-making considerably. Another thing you must understand if you want to prevent crashes from ruining your life is something I call margin of safety. Now, margin of safety sounds technical, but it's really just common sense dressed up in accounting language. It means you prepare for things going wrong before they go wrong. If you build bridges, you don't design them to hold exactly the maximum expected weight. You design them to hold far more than that. Because eventually someone drives a truck across your bridge carrying machinery they absolutely should not be transporting, and you want the bridge to survive anyway. Investing works the same way. If your portfolio only works when everything goes perfectly, you don't have a portfolio, you have a financial house of cards waiting for a breeze. Now let me talk about diversification, which is one of those words that sounds intelligent, but is frequently misunderstood. Diversification protects you from ignorance. If you know nothing about businesses, diversification is wonderful. If you actually understand businesses, excessive diversification becomes what I call do-orsification. Owning 100 investments you barely understand does not make you safe. It makes you confused. And confusion is a dangerous state during crashes because confused people make emotional decisions. The goal is not to own everything. The goal is to own enough durable, understandable businesses that one mistake doesn't ruin you. Now, here's something people rarely appreciate about crashes. Crashes are not primarily economic events. They are psychological events. Markets collapse when fear spreads faster than rational thought, and fear spreads very quickly because human beings are social animals. When everyone around you is panicking, your brain begins whispering helpful little suggestions like, maybe we should panic too. Evolution trained you to survive predators, not portfolio volatility. If your ancestors ignored panic signals, they got eaten by lions. So your brain is wired to treat danger signals very seriously. Unfortunately, the stock market is not a lion, but your brain reacts as if it is. Now here's the paradox. The very instinct that kept your ancestors alive can make you financially suicidal, because during crashes, selling feels safe, and during booms, buying feels safe, and both instincts are frequently wrong. One of the most reliable crash prevention strategies is extremely simple. Own businesses you can understand well enough to remain calm when prices collapse. If you don't understand what you own, price declines feel like existential threats. If you understand what you own, price declines feel like temporary discounts. You shouldn't own it for 10 minutes. That statement sounds poetic. It's actually a crash survival strategy. Let me tell you something else people misunderstand about crashes. Crashes are not the enemy of wealth. They are the transfer mechanism of wealth. Money moves during crashes from impatient people to patient people, from leveraged people to conservative people, from emotional people to rational people. Now, the next principle for crash prevention is liquidity, and liquidity is incredibly boring, which is why most people ignore it until they desperately need it. Cash is like oxygen. Nobody talks about oxygen when they have it, but when they don't have it, it becomes the only thing they care about. If you have liquidity during crashes, you gain two enormous advantages. You avoid forced selling, and you gain the ability to buy when others cannot, because it removes choice, and investing without choice is gambling. Another critical crash prevention habit is avoiding complexity you don't understand. Financial history is filled with extremely intelligent people destroyed by investments that required PowerPoint presentations to explain. If you need a 60-slide presentation to understand how something makes money, you probably shouldn't own it during a crisis. Complex systems fail in complex ways. Simple businesses fail in understandable ways, and understandable failure is easier to survive. Let me also warn you about optimism. Now I'm a fan of optimism. Optimism builds businesses. Optimism builds countries. Optimism gets people married. But optimism without caution builds financial disasters. The best investors I've known combine pessimistic preparation with optimistic patience. They assume bad things will happen, but they assume they will survive them. That combination is extraordinarily powerful. Now let's talk about valuation. Overpaying for good businesses is one of the most reliable crash accelerators. And the reason that becomes so dangerous is very simple and very human. When people fall in love with a great business, they stop thinking about price and start thinking about admiration. Admiration works beautifully in friendships and marriages, but it's very expensive in investing. A wonderful business does not automatically become a wonderful investment. That only happens when the price makes sense. When investors ignore price, they are essentially paying today for perfection tomorrow. And perfection is a very unreliable business partner. Think about it this way. Imagine you find the best apartment building in town. Perfect location, reliable tenants, excellent management, but the owner asks you to pay 40 or 50 years of rental income up front. At that point, it doesn't matter how good the building is. You've just made a terrible investment wrapped in a wonderful asset. Arithmetic eventually wins every argument, even when enthusiasm tries to interrupt it. Overpaying becomes especially dangerous during crashes, because high expectations create fragile confidence. When expectations are unrealistic, even small disappointments can cause dramatic price declines. Markets tend to forgive average businesses bought cheaply. They rarely forgive great businesses bought at ridiculous prices. If your answer requires everything going perfectly, constant growth, flawless management, favorable economic conditions, you're probably building fragility into your portfolio. Strong investments can survive mistakes. Fragile ones cannot. Now let's talk briefly about durability, because valuation alone isn't enough. You also need strong businesses. Durable companies usually sell products people continue buying regardless of economic conditions. They generate consistent cash flow and maintain competitive advantages that make it difficult for rivals to replace them. Fragile businesses often look impressive during good times, but they depend heavily on perfect conditions. When the economy weakens, those weaknesses become obvious very quickly. Balance sheet strength also plays a huge role in crash survival. Debt is one of the fastest ways to turn manageable business problems into disasters. Companies with strong balance sheets have flexibility during downturns. Companies overloaded with debt often don't get that luxury. Creditors tend to demand payment whether conditions are favorable or not. Liquidity is another overlooked protection. Holding cash feels uncomfortable during bull markets because it appears unproductive. But during crashes, liquidity becomes freedom. It allows investors to avoid forced selling and occasionally buy great assets at attractive prices. Forced selling is one of the worst financial positions anyone can experience. It removes patience, removes control, and usually produces poor outcomes. Another silent risk factor is complexity. Investors often believe complicated investments must be sophisticated. In reality, complexity frequently hides fragility. Simple, understandable businesses are easier to evaluate during stress, and clarity helps investors stay rational when markets become chaotic. Temperament also matters enormously. You don't need extraordinary intelligence to survive market crashes. You need patience, discipline, and emotional stability. Human beings naturally want to act during uncertainty, but investing often rewards thoughtful inactivity far more than constant decision-making. Envy is another dangerous force. During bull markets, envy pushes investors toward fashionable trends. During crashes, it turns into panic when others appear to be doing better. Buffett and I always found it more useful to measure success by our own long-term standards rather than comparing ourselves to others. That simple habit reduces enormous psychological pressure. Here's the reality investors must accept. Crashes are inevitable. Financial destruction is optional. You cannot control markets, but you can control preparation, discipline, and behavior. Over long periods, those factors matter far more than predictions. Investors who succeed across decades are not the ones who avoid storms. They are the ones who build strong ships. And if you build your financial life that way rationally, conservatively, and patiently, crashes stop being disasters. They simply become part of the journey.